our friends Brent Swatuk and Giuliano Savini in the past, and you're in for a real treat. I see we've got lots of people from all across Canada on the webinar today. And without any further ado, I'm going to go backstage and hand it over to Brent Swatuk.
I'm going to take you through, so the presentation that we're going to go through is embedded in the middle, which is Levelize the TAX. What I am going to do is about a year or so ago, I spoke to a group of 200 accountants. The idea was, why do business owners buy insurance? Why would they even consider buying insurance? Why do they hold insurance? And it was just ideas to share around that. So that's what I'm going to share with you folks today. It's a variation of Levelize the TAX. It's maybe got a little bit more stuff wrapped around it. And hopefully it holds a little bit of something for everybody that's in this space. So disclaimer is, obviously we do our best to make sure that anything we're showing you, that the taxation is right on it. Obviously, if you're in a province other than Ontario, it's probably going to fall outside of that, but just follow along with me. I'm sure that you can stick with the gist of the presentation. I'm going to give you a little brief overview of Equitable Life, just in case you aren't aware of who we are. These were, as I said, this was something built for accountants. It wasn't really meant to be a convert everybody to Equitable event, but we did want to let them know who we are as Canada's darling mutual company that offers par insurance. Talk to you a little bit about why life insurance and why life insurance. So once again, hitting on what they wanted me to speak on. And then corporate owned life insurance is unique asset class. We're going to talk a little bit about our wealth accumulator. It's not so much the redesign because it's been out for a while, but it is balance sheet friendly. So I do want to take you through a little bit of idea on that. And then we're going to dive into that piece, that Levelize the TAX piece. And that's a conversation that can be had between you and clients and you and their accountants to maybe look at things a little differently. And to be frank, it was Don Hart that actually introduced me to this concept. He used a much better word called flatten the tax, but apparently our compliance department doesn't like the idea of flattening anything, but levelizing it seems to be okay. So the talk will be around Levelize the TAX. And the last thing I want to show you is portfolio enhancement strategy. So I'm going to show you, it's a beautiful little presentation. I think it really boils down to one page. And I'll talk to you a little bit about how I use it with clients. And I use this as recent as last week on a couple large deals where we set benchmarks, and we know if we can beat those benchmarks, then we probably have something further to talk about with them. And so hopefully all this holds something to you. This is all stuff that we do use in the field when I'm out in front of clients. So hopefully, you'll be able to take it and run with it too. I'm completely open to you putting questions in the chat as we move forward, and Don will interrupt me. I'm happy to, if you want to hold them to the end too, but I always like to kind of close as we're going through and not have to have a hard close in the end. So here's my very brief Equitable Life stuff. We were founded in 1920. So if you're doing the math, yes, we are going to be 103 years old as of this year. We are a mutual company, meaning that we do not have shareholders. We do everything for the benefit of our policyholders. You may hear us talk about mutual, but what we actually talk about in head office a lot is equitableizing everything, making everything as equitable as possible. And you're going to see a lot of really cool changes come from our company on all product lines, and just really about being way more client centric than even what we have been in the past, and making sure that we're passing through profitability and benefits whenever possible, and not just with par. Actually, we're going to be looking to do that across our product shelf. So really exciting times. We've been offering par since 36. We have paid a dividend every year since 36. So that means every series of contract has paid a dividend since 36. And that's a pretty unique statement. Yes, I realize there's folks out there that know the whole 100 plus years always paying a dividend, but maybe not on every series of contract. And when it comes down to our product, what makes us special is our product. When you look at our actual par fund mix, we've been really good at getting yield on our par fund. Our size has actually been a strength to us. And we were one of the first par funds, if not the first par fund, to have to hold assets in the United States. So we have done a really good job on getting yield on our underlying assets. And if you know anything about par, it's all about yield. A little bit more about our company. A couple of years ago, when minimum continuing capital surplus reserves, or MCCSR, was going by the wayside, we didn't know where we'd land from a stability standpoint or from a financial strength standpoint. We knew we'd be good because we sold a lot of par, but we really didn't know where that was going to land. And so we went out and got bond rated. So we got bond rated to kind of just demonstrate our strength and stability for the size of company that we are. And by the way, we came out with an A stable first, and now we've gone to an A high, which is a really good place to be for a company of our size. But understand, we did not get bond rated to go out and raise money. Yes, this does allow us to do that. We did it more so that way for people that put stock in bond ratings, we had a bond rating on hand. We went DBRS because they're Canadian. So yeah, we don't have every other rating agency with us because it does cost a lot of money to get rated. But the fact of the matter is, we're not rated because we're not trying to do bond raises and stuff like that. The main thing is we're A high, and that's a really good place to be for a company of our size and growing. So I mentioned MCCSR. This new accounting measure came in called LICAT, which measures your capital adequacy ratios. And the benchmark is 100 for the regulator, and we're at 153. It's not to say that all of our peer companies are not doing well. They're all above 100, which is where you want to be. The interesting thing about us is there's bond raising, right? This is just purely on the fact that we're profitable and we sell a lot of par, and that's heavily asset backed, right? So it's a really good news story to say, because yes, I hear the stories of Equitable's that little unknown company. Well, you know what? That little unknown company is very financially stable. And I think that's what we want to be telling our clients, more than the, hey, if they demutualize story, which we do hear a lot of. The real benefit to us is if we stay mutual, because if we stay mutual and we keep getting good yields and we keep being profitable and we start passing that back, that's a really awesome story, because our main priority is taking care of our number one stakeholder, which is your client. And if you're interested in knowing more about this, although the cover has changed with some new branding that we've launched, we have a piece called the Advanced Markets Brochure. You can reach out to your regional sales manager. They can hook you up with this brochure. This brochure was originally designed for high net worth individuals and our stock brokerage or national account market space. And it was really done to say, who is Equitable Life? What are they about? What's their main product, which is par? And what are they like from a corporate culture standpoint? So really great brochure just to kind of introduce who the company is, maybe to a client that really isn't as familiar with us. Okay, enough about the company pitch. Let's get on to what we want to talk about, which is how do we talk to clients and why do we talk to clients? And believe it or not, as I said, I did this to a group of, it was approximately 150, 200 accountants. And you would think, well, Brent, you're not an accountant. Why are you speaking to accountants? Well, number one, accountants want to know this stuff. They want to know how this works, and they want to know why people make the moves they make. And then from there, they start to evaluate, well, maybe I have clients that this would be applicable to, right? And you're going to meet some accountants that are absolutely super slick and can teach you about the way CDA works and everything. But you're going to meet a vast majority out there that, you know what, that's not what they do, right? They acquire clients, they help them build their businesses, they help do the accounting, and they rely on folks like you to bring these sorts of planning advice to, right? So why life insurance? Well, there's a number of reasons why a business owner will consider life insurance. It's that they have a need for liquidity on death when something key happens, right? So it could be the loss of a key person, making sure that, you know, they have enough money on hand to go hire replacements, that they can keep the bank at bay, whatever, that, you know, that they can pay off loans or whatever it is. They could be that they have a shareholders agreement that they need funded. You know, we could be dealing with an incorporated solopreneur, basically, that has, you know, if they pass away, there's going to be some taxation. There may be a need for estate equalization. So I call this solving for X, right? What we want to do is figure out where they are, what they value, and what the potential problems are, or the unforeseen problems are, right? Or the blind spots in their business, and bring that forward. That's the X, right? And once we get consensus around that, then we start to talk about what are all the things that can be done to get rid of that. So if we were dealing with, you know, estate taxes, you know, we want to know what's the accountant planning, because we want to explore everything in conjunction with their professional advisors to make sure that before we just say life insurance is the answer, that we're getting down to the right number, because there's nothing worse than us making a plan based around a number that's not actually the number, right? And anybody that's made a plan and not realized that the accountant is planning to use pipeline, and all of a sudden what you've planned on is up here, and then how he's going to eliminate or shrink the taxes is down here, you kind of start to blow a bit of credibility. So what we want to do is, before we just go out and pitch and propose life insurance, we want to make sure that we're doing it within the structures that are there, that we understand if they've done a freeze, that we want to understand everything about this company and what the plans are. That's basically what it comes down to. By the way, I can tell you that there was consensus when I did this presentation. Every accountant was shaking their head. They want to be worked along with. They don't want you making assumptions as to how things are going to work. They want to be a part of it, and they want to make sure that everybody realizes who the trusted advisor is, and the trusted advisor is 99.9% of the time the accountant. The next thing we have to do is look at alternative funding options, right? And we call this the uninsured sale. So basically, what are all the ways you can pay the tax bill without being biased towards any one of them? So we want to examine every way that this client can pay that tax. So quick example on this, and this is another calculator that we have here, and I use this a lot. I'll actually just draw this on people's whiteboards and stuff a lot. But if we had a male 50 that needs $2.6 million at life expectancy 85, what are all the ways that we could pay that? Well, if his money's in his corp and he doesn't want to take it out, that's going to cost him a lot of money potentially, right? So, remember, it's going to take, so these first two bars are what we call sinking fund, right? This one's paid annual, this one's paid in lump sum. And in order to end up with $2.6 million at 85, they got to give you $2.5 million over a 10-year period, right? At a certain interest rate. All the math is in behind this. You'll have to trust me. I think it was about 3% that we used. But basically, they'll give you almost $2.6 million. You'll grow that for a 35-year period. And then when they need it, they'll pay that out as a dividend. So they're just going to pay a ton of tax along the way. They're going to pay an exit tax getting it out. And then they're going to hand that over to the tax man. So not really exciting, especially too if we know this business owner is an opportunist, and they like to invest in things like private equity or private debt or real estate or stock market or back into their business, whatever that is, and they know they're getting strong yields. Putting money in sideline money to take care of this tax is going to be very unappealing and probably break their value system. So but it's an option, right? So we have to present the option. The next bar on here you'll see is if the corporation borrowed the money and paid it out, they'll pay out the almost $2.6 million of benefit out, but then they've got to pay back that 2.6, plus they got to pay the interest on it. So borrowing money from the bank, not guaranteed, and also very expensive. Right? But yet every business owner, when you say, hey, how are they going to pay the tax? What do you think one of the options is? Well, they can leverage it, right? They can borrow from the bank. And what we need to do is we need to bring out the numbers and evidence to them that, although they could maybe do this, it may not be as easy as what they think. And it's ultimately very expensive, right? Now, obviously, this number goes down. You could get a much lower number on this. If the kids can go to the bank personally and borrow that money, it's not going to cost them $6.7 million. But if the business is the only place that can get that loan, that's an expensive way of doing this. There is a bar missing in here, and it's because it's a hard to quantify bar. And that's turning bricks and steel back into cash. So what they could do is, and anybody that's dealt with anybody in real estate knows this, inevitably you have a conversation about the taxes that are going to be due. And the lady or the gentleman that you're sitting in front of says, well, that's okay. They can sell building B and pay the taxes off on building A and keep that. And that assumes that they can get fair market value selling under duress and that market conditions mean nothing. But the fact of the matter is, if I know that you have to sell under duress, I do not want to pay 100 cents on the dollar. In fact, I want to play closer to 50 cents or 40 cents on the dollar because I want to know that I immediately have growth on my money, refiability, and I know that it's going to appreciate over time. That's what makes it a very solid deal for me. And it's all about me in those scenarios and not about that widow or that widower that has to sell that building. So converting bricks and steel back into cash is an extremely expensive proposition. And if you don't want to save the money and you've got 30 years in which to pass on that stewardship, that's a tough thing to do, because a lot of these business owners don't want to put in the time to make sure their kids understand how all this works, so that way if they have to dissolve it, they get top dollar on it. The last bar, which we can quantify, is this little one over here, and it's called life insurance. And corporately, we're going to put in $700,000 over 10 years. And if this individual passes away at age 85, it's going to produce $2.6 million out through the CDA. And I just went through this whole thing, but if you only remember this, okay? Big bars are bad and little bars are really good, right? And so at the end of the day, if they put 700 grand into this thing, then they can take the other the 1.8 million on an annual basis that they would have had to do in the sinking fund, and they can invest that in something they actually want to do. So life insurance provides pennies on the dollar, lowest cost option on the board. And it provides it with certainty, because it's guaranteed to turn into liquid cash at the exact moment that you need it, which is when your heart stops beating. So love the alternative funding and the uninsured sale. Hopefully that meant something to you. Talk a little bit about why whole life inside of a corporation and why it's a unique asset class. And so we all know that I'm assuming we all know, but we all know that it's obviously cheaper to pay $1,000 in premium corporately than what it is for you to pay it out of personal pocket. So if we look at a sole proprietor that's paying top tax here in Ontario, they got to earn $2,000 to net down to $1,000 to pay the premium, right? Whereas if they bought it in their corporation, they got to make a little over $1,100 to pay that same $1,000 premium. So what does that mean? Obviously, it makes sense for us to pay the premium in the corporation if it makes sense. Now, caveat to that is we want to make sure that wherever we're sticking this policy, we're sticking it into a forever home sort of corporation. So like a holding company or a capital corp of some sort that we intend to hold until we pass away, and probably perpetually pass that with our heirs. And so we want to make sure of that, because structure at the end of the day is very, very important. And so, once we get past this, we all know that business owners want to pay for things out of their corporation. They'd rather write a corporate check than a personal check every day of the week. But from a tax perspective, it makes sense for them to write that premium from the corporation. So when we can accomplish that and we can get that money into the life insurance, we'll see why that makes really good sense. And so when we look at a holding company, operating company, capital corp, professional corp, that's here's what exists, and there's money in here. And this business owner has to make a decision of where they're going to put that money. There's only typically so many places they're going to invest that money. And we're not here to tell them the way they're doing it is wrong. What we're here to see is there a way that we can maximize or get a better result with what they're doing? Now, you'll notice it says operating company. A second ago, I said, you don't want to have it in the opco because, for everybody that's looking at it, and you see operating company, you're probably like getting squeamish saying, well, Brent, if you do that, you're going to eliminate the capital gains exemption. You're right. But in some scenarios, some operating companies are not saleable. And so if the company is not saleable, then I don't really care about capital gains exemption. And that may be the forever home for those assets. Now, you might be saying, well, but what about creditor protection? And what I would say to you is every corporation needs to be evaluated, because if it's, let's say, a doctor, we're going to probably buy investments. We're probably buying insurance in there, and he's probably okay with it because he has enough liability insurance to cover that off. So when in doubt, always find out, are they going to hold that company forever? And do they have sufficient liability insurance to make sure that if they did get sued and they had to make restitution, that there's insurance there to cover that and not their assets? So getting back to the playbook here, we've got a holding company and it has money, and your client has to decide what to do with that money. And your role is to find out what they're doing with that money. And not only what they're doing with it, but what sort of yields they're getting, and what's their role in that? Are they active in the deployment and purchase of these investments? So if we take a look at fixed income, and this is a matrix you can do with all your clients, I can tell you, I do it with clients all the time. My role here at Equitable as advanced case consultant is not only to do like this sort of speaking and fun stuff like this, but I'm actually a paraplanner, and I do get out in front of clients and help them with planning. And we talk about real things like what they're actually doing and what their role is and all that fun stuff, what they'd like to see have happen. So we got this money and it's going into fixed income. And this is really the matrix of what we're going through. What's the growth rate like versus the risk? And why do they like this? So for a business owner that takes all the risk in their business, we might see a lot more fixed income on their balance sheet than what we might see even portfolio and stuff, right? And so, we want to know, like, what's the growth? Well, the growth right now is decent. I mean, a year ago, 2 years ago, it wasn't decent, but the risk is low, right? And that's the reason why they're probably doing it, is they value cash or cash alternatives on their balance sheet because of the risk they're taking in their business. What's the tax treatment like? Well, tax treatment's horrible, right? Because once we make $1, we go right to top passive corporate rate tax, and we're paying 50.17 here in Ontario. It's uglier in the East Coast. It's roughly the same in the West. I've paid small tax, and now I'm paying ugly rate of tax on when I do my investing, right? When I got that fixed income in there. What's the access like? Can I get access to it? Well, if it's cashable, I might be able to get access, but if it's cashable, I'm probably not getting the best rate out there. So it depends on the terms. And you can leverage on a bond, you can leverage on a GIC, but depending on the terms will depend on what the bank's going to give you. So you might see anywhere from 60 to 75 cent leverage point on a bond, right? Or a GIC, depending on what the terms are. And, so that's great. No problems there. From a distribution standpoint, I pay tax. When I earn the money, I'm paying big tax, as I said, as I'm growing it. And now to get it out of the corporation, I got to pay tax again. And yes, there's a thing called RDTOH, which helps reduce some of that tax, but it's still a grind on tax, folks. So it's tax on tax on tax. Yes, there is some relief along the way, but it's still tax, right? So distribution is okay, but it's not great. And we're going to see some examples of that. And then we go through the exact same matrix with equity. So, hey, growth is better, but risk is more. Tax treatment is definitely better, especially if it's capital gains. Access, though, not so good, right? Like, because if it's a bad equity market, we can't just get our money out without taking a loss. And if we want to leverage it, most folks, if they'll take equities, are going to take it at about 50 cents on the dollar. So, once again, I'm not getting as good a leverage point. And from a distribution standpoint, though, it's much better than those fixed income, because anything that gets a capital gain gets a credit to the capital dividend account, which we'll talk about in one sec. We do the exact same thing with businesses, real estate, private equity, private leverage. We would want to explore whatever the client is doing. Obviously, we're not going down rabbit holes that the client's not in. We want to make sure we're talking about what they get. And we want to know what sort of growth they're getting. And if you do this matrix, you have the right to ask them. You also have the right to ask them if they are deploying their assets themselves, or if somebody else is doing it. Are they turning that over to someone? The last asset class that we typically want to talk about here is life insurance, right? And so what sort of growth are we getting? Well, it's typically somewhere between fixed income and equity, right? What's the risk like? Well, it's a lot more like fixed income, because once we earn money in it, it vests to the contract, right? Unless we pull it out, it's vesting. How's it from a tax treatment? This is where it starts to get like really good, right? As we start to grow our money and as it starts to build up, we got tax deferral here. So that's one of the big advantages here, especially with that passive investment rate grind down that we all know goes on in Canada by the government. So not only do we have ugly tax, but then we've got additional tax things. We're not going to go down that rabbit hole today, but if you don't understand that, reach out to one of your regional salespeople, reach out to me, reach out to Frank Abate or Chris Britton in the East and Brad Hyde in the West. Sorry, almost forgot there. Those folks are incredible resources for you, and they can help you build a case around this. You should know this stuff. But if you don't, you have these incredible resources to lean on. So life insurance from an access standpoint, yes, I'm not giving up, as Don would say, my liquidity, use, and control of that money. So I can borrow on that money anytime I want, right? So I can take a lien from the par fund against that asset. But I may want to just leverage it with the bank because, maybe the ACB is really low on that contract. And the cool thing about life insurance is it's got one of the highest leverage points of any of the assets out there. So on back end leverage with just beacon score and cash value, it's 75 cents on the dollar. But if your client can underwrite, we can go higher to more like 90 or 100 cents on the dollar. And that's a really cool piece because no other asset will do that. And that's because the bank knows they can walk in and cash out that contract at any time. It's as good as cash. So that's what makes it a really unique asset is we've got strong growth, low risk, tax deferral, great access point. And when it comes to distribution, there isn't another asset that can do what we can do. So I'm going to flow into the next page, actually, which talks about capital dividend account and life insurance. And kudos to all you folks for everything you do with your clients. Okay. It is a tough business that we're in. But when clients get it, they get it. And you make very, very big impacts, not only to those families, but those communities. And one of the cool things about life insurance is that if you stroke your name on a paper today and you pass a medical and you transfer money to us and you get hit tomorrow, we deem that an eligible claim. Not only will we produce a whole ton of money in the way of life insurance, but a vast majority of that is going to go out through the capital dividend account. And when we're dealing with par as an asset class, we're really looking at somebody's life expectancy. And the idea is hopefully at some point that ACB is going to be zero, that adjusted cost basis, right? Not to be confused with adjusted cost base. And if you're watching a whole ton of TikToks out of the United States, learn Canadian tax, folks. But in Canada, that ACB will grind to zero and we will get full inclusion of that death benefit into the CDA. And that allows us to strip the money out on a very tax preferred basis called tax free, right? And is life insurance the only thing that gets this? No, if you take a look up top, if I sell you a stock for $1 and it makes $1, so it grows to $2 and we trade it, that dollar of gain, the first 50 cents of that gain is going to get a credit to the capital dividend account. You buy a house for 100 grand, you sell it for 200, you're getting 50 grand of CDA. Now, what makes us so unique on this is not the stockbroker, not the realtor, neither their accountant nor their attorney can impact the CDA the way a life insurance professional can. And not only that, we bring the money, folks, right? So when the money is needed, the X we solve for, your heart stops beating, that money comes due, we provide the liquidity that happens plus all the additional tax benefits. So we take money that's been taxed at small dollars, tax defer it, and turn it into tax-free CDA. It's a really special thing that we do, folks, and we should always be very proud of that. If I could sell you a lease on life, so if I could say that for the next 40 years, you can run your game full tilt, you will never get sick, you will never die, would you buy that lease on life from me? The answer is yes, 100 times out of 100, because they don't want to buy life insurance. What they want to do is buy that next property, right? What they want to do is reinvest in their business and grow that because that's what they're passionate about. But the fact of the matter is tomorrow's promised to no one. And at the end of the day, what we have seen is estates without life insurance typically get ravaged badly. And so if there's always a method on how somebody should buy it. So like if somebody said, hey, I don't want to buy life insurance, I just want to invest back in my business. They say, great. Well, what sort of yield are you getting on your business? Oh, you know what? On average, I've been averaging 22%, right? I'm pulling a fictitious number. I'd say, okay. Well, if you happen to pass away, this we know is the tax bill. Well, yeah, but I'm healthy today, right? I just want to keep doing what I'm doing. I don't want to buy this crap. Okay, fine. So we have two choices. Number one, you can hedge it with term insurance, right? But we all know that 10 years from now, you're going to want to punch me in the face because the cost is going to go up. You don't have anything on it. It's a zero. It's a loser on your balance sheet. Not going to be happy with this. The other option is we could look at par as an asset class, but we can look at leveraging out of that. So what could we leverage that at? We call that the IFA or the immediate finance arrangement. And really what we need to know is what's the arbitrage rate between what you're going to borrow at and what you're going to earn, right? So what's the upside on this? So if you could borrow today at 7, but you're going to make 22, that means 15 in my world. And what that would mean to you is we put money into the life insurance, we secure your family, making sure that they have the liabilities covered off, right? And you don't have to miss out on that opportunity over there. It's just going to cost you some of your yield. And so that may be one strategy that we go down. Another one may be that, there's a number of different things that we could look at. Nobody wants to buy life insurance, but then again, nobody wants to die. And let's face it, no man or woman dies at the exact right time. Everybody dies in the middle of a project. They never die at the end. What we're usually looking at doing is repositioning fixed income. Not even all the time it's the full fixed income portfolio. Sometimes it's just a portion of. What you'll notice is what we're trying to leave, although it says equities, it's not always equities with clients. Sometimes it's their business, sometimes it's startups, sometimes it's private equity, sometimes it's private leverage. You've got to figure out what that client values. And then from there, what we're trying to see is there a way to make this make sense? And a lot of times there is, which we'll see in over the next couple slides. If you haven't looked at our wealth product, we got a really cool wealth product. We redesigned it a couple of years ago. One of my early mentors when I was with my previous company was a guy by the name of Dennis Capone, senior, love senior, shout outs to senior. But what he did was he took me through a whole life illustration and showed me it in a totally different way. And what he said to me was, Brent, how deep is the water? And it turns out in our product, it's 3 feet deep in most cases. So if you buy a max, well, this isn't the max funded contract because you can add a term rider and jack this thing up even more. But if you buy just an overfunded contract, it would work in a term rider contract as well. By year 3, the cash value is growing by more than 100 grand, right? By year 5, it goes from the red to the black. So my clients, even at that point, they walk away. They probably have some small tax to pay, but it's probably not as bad as a weekend in Vegas for them. And you know what? They had life insurance all along the way. And the real reason why they're buying it is because they need the life insurance now. They like the asset on their balance sheet. And just like some folks that I was talking to last week is, you know, you're going to make an exit from your business. At that point, you're going to be flush with more cash and more decisions than you've ever faced. And having life insurance in your portfolio is what's going to allow you to spend that money in retirement. Now, understand, they can leverage on this as they go away. So as Don was mentioning, and asset, liquidity, use, and control, they can absolutely call this back into their financial life and recall it back into their, repatriate it back into their corporation or back into an opportunity. We sometimes hear this called the wealth fund or opportunity fund. I'm cool with whatever you want to call it, as long as you know, we're doing it right. And at the end of the day, we get full CDA inclusion at year 37. It's a really, like, I mean, at 85, they're, you know, they've put in, what did they put in, $1 million? It's worth like $4 million. It's a good deal. It's not a horrible deal at all, especially because it's all going to come out of the corporation tax free. So let's dive into that levelize the tax talk. I can't see anybody's faces or hands, but I assume that if I asked this question in a live audience and I said, how many people have clients paying more than they need to in tax on fixed income, everybody's hands would be up. And if they're like most business owners, they absolutely are paying more in tax. What their accountants are typically doing is they've got a portfolio, or they might only just have fixed income or whatever it is. What happens is they have money invested, and their accountants, when they're doing their taxes, typically will take enough out of the investments, out of the winnings, right, to pay the tax, and the balance gets reinvested back into whatever the X is, whatever the portfolio is. There's an uglier version of this where they don't pay the money out of the winnings, right? We call this increasing the tax bill. When they pay the money out of other earnings, that's called compounding the tax bill. But we're not going to talk about that today. We're going to just talk about increasing the tax bill. And so when they do this, we know that there's a ton of money lost every year. And not only is it the money that they lose every year, but it's the lost opportunity cost, because they're never going to make money on that money once they pay the government. Once that's out of their financial life, it's gone forever. And if there was a way to recall that back into their family's financial life, we might have something that we would have a basis of which we could discuss, right? Whether it makes sense. So I'm going to give you an example. Don't get hung up on numbers. We can do this. I've done this as low as a couple $100,000. I've done this as high as like multiple millions. And a good friend of mine in you know, every year does this with folks. And I mean, he's a 7-figure producer, and this is like one of his main shticks that he talks about with people. And so if we had a male 50 that had built up a war chest inside of his corporation, taking all his risk in his business, and he had GICs that were paying 5%, right? GICs, bonds, whatever, paying 5%. By the way, when I said this a couple of years ago, everybody was like flabbergasted. 5%, where are you going to get that? Now people actually think it's doable. So if we had a 3,075,000 balance, that would spin out at 5%, 153,000, assuming a 50% tax rate, just kind of rounding that for easy math, folks. They would pay $76,000 in tax, and they would end the year with 3.151. And if you know anything about balance sheets, they won the balance sheet game at the end of the day. If they didn't put any money into it, and the balance sheet at the end of the year is greater than the beginning of the year, then they win. And if they did this for the next 35 years and just let it roll, and they never needed to touch this money, 3 million would turn into like 7.3 million. And their family would get that if they passed away on that day, or they would get what comes out net of taxes. And you know what? They would feel okay with that. They might have gotten more somewhere else, but they didn't take any risk and they'd feel okay with it. If we just look at this, if we look at beginning, opening to closing balance, what we forget to look at is the cumulative balance of all the tax that we've transferred away. And it's not only all the tax dollars we transferred away, but it's the lost opportunity cost on that money. So over that 35-year period, although they'll get 7.3 million bucks, they paid away $4.2 million in tax. And everybody has to pay their tax. It's a social system, right? Our social systems run on tax revenues. Everybody's got to pay their fair share, but nobody says you have to pay a big tip, right? And we all know that there's two tax acts for those who know how to use the tax act, and then there's the tax act for everybody else. And so if we know how to use the tax act and we arrange things properly, is there a way for us to restructure things and make 1 + 1 = 3, 4, or 5? Is there a way for us to recapture some of that tax and bring that back into our family's financial life? This is a bar chart saying the same thing. So this is increasing our tax bill. And what we want to talk to you about is how you can legally pay less in tax and flatten that tax bill and increase your family's wealth. And the solution is levelize the tax. And so what we would do here, by the way, we don't normally just throw up that it's exempt life insurance, because as you know, people like curl up in the fetal position because they remember Uncle Joe bought life insurance and then he lost money and blah, 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 blah. What we want to do is what my buddy says is we're going to take that money. So what's going to happen is as that portfolio produces a yield, your accountant's going to pay the tax, but as opposed to reinvesting it back in the portfolio, what we're going to do is we're going to take that money and we're going to put it over here into another room. And that other room has all the qualities of tax-exempt life insurance, right? Permanent participating whole life insurance, because that's what we're actually putting the money into. And so if we take a look at this example again, and we look at it a different way, we say, okay, we got a $3,075,000 balance, right? We're going to put $75,000 into the policy because policy premiums are paid annually up front, right? That leaves us with a starting balance that year of $3 million bucks. It earns 5%, which is $150,000. They pay the tax of $75,000, leaving $75,000 to go into the other room, into the life insurance premiums, right? The closing balance on this is $3 million bucks. If all we did was examine the balance sheet here, we'd say this is a total loser, because we start with 3 million, we end with 3 million. At 35 years go by, it's worth 3 million. This did not win the balance sheet game. But remember, we've got some action going on over in the policy, over in the other room, right? So we gotta evaluate both simultaneously because we've been transferring money to the other room. The big thing to note here, though, is take a look at what happens in the tax column. If you remember, in the previous example with just the portfolio, that's just the, hey, you just keep doing what you're doing, pay your tax, 4.2 million bucks. But if we use the other room methodology, right, if we use par as an asset class for levelizing the tax, we reduce the tax bill here by $1.6 million, putting the money into the other room. So let's see what we get in the other room. Well, premium goes in, it starts up with a cash value, underwater for 2 years, right? Above water starting year 3, break even year 5. We're ahead there every year thereafter, and it starts to build. In addition to that, it starts to build a death benefit. And so if my client passes away here at age 85, I will have reduced his tax liability by 38% over that time. And in addition to that, we'll have the $3 million in the fixed income plus the $6 million of the death benefit, and we'll increase the amount in the corporation by 32%. So how many clients have, just by making a shift? And remember, let's go back for a second. There's a cash value here, right? I'm not giving up my liquidity, use, and control of that money. I've got full leverage point on that wealth fund or opportunity fund. But if I pass away, it is a smarter arrangement because it leads to a much bigger benefit, 32%. Just by making a pivot in how they hold their portfolio, we get a 32% better bump than what we did just holding it into the fixed income. And remember, the growth is slightly better. but the security is about the same as fixed income because the vesting provision. But remember, this is only inside the corp. So we beat the money inside the corp. What does it look like though when my wife or my kids want to get that money out of the corp? Right? How does it look when we get through the CDA? And what happens here is we've got that additional taxes to pay on the just portfolio. So that grinds 7.2 down to 5.4, and 9.6 grinds down to 8.5 because of CDA inclusion and the RDTOH on the fixed income portfolio, right? So we end up with 57% more estate going on to the heirs, right? Going on to my spouse or my heirs just by making this change. And I haven't given up my liquidity usage and control of that money. So that's what starts to make this a really interesting conversation. Now, if a client said, Brent, I could care less if my kids get 8 million or 5 million. Yeah, I'm fine if they get 5 million. And I'd say, well, great. Well, what could we do with 3 million? Well, that's 3 million more that you could spend in your living years, right? That's 3 million more that you could take your family away while you're still alive and you're in those go-go years. That's $3 million that you can donate to hospitals, charities, or whatever you want to do with that, right? Your alma mater, whatever it is that you care about, your church, the SPCA, I don't really care. But the fact of the matter is, we're able to recapture that wealth back into your family versus transferring it away to Justin and the boys, right? So we want to make sure that we're exposing clients to the idea that it's not just about the yield. Sometimes it's about the asset and what it can do for you. And what Levelize the Tax does is it levels out the tax and recaptures that tax. It's an immediate increase in estate value. So whether you die in year 1 or you die in year 35, it's an immediate bump in your estate value, right? And it's a massive bump in the later values. You accumulate wealth more efficiently because this is growing tax deferred, which means you're not subject to that small business grind down, right? If we use this thing and you're not above that $50,000 threshold. And you get greater distribution out to those heirs through the CDA. And remember, no other professional can impact the CDA the way we impact the CDA. Okay, so I'm going to jump into the last little bit, and this, I'm not going to take this too long on this one. I use this strategy all the time with advisors. I was telling Don before we got on here, I used it 3 times last week on some very large cases. And if you like it, you can reach out to your regional salesperson and they can, connect you with some examples on this for clients. This was a business owner, 43, had been approached to sell his business before, had done a reorg, was looking to sell the business in about 10 to 15 years, currently had only cash inside their company because they felt they were taking the risk. At the time, they thought they were getting about a 3% return. They have term insurance, but they were open to discussing part and seeing if it did hold any value to them. And so what we did was we collected a bunch of data here and we put it into the portfolio enhancement strategy. So here you'll see we got our male non-smoker 43. It's held inside of his holding company. Let's not look at all this stuff right now. What we did was we found out what was the balance of his retained earnings and what were they retaining on an annual basis. And so the balance currently was $706,000. The retained earnings were getting stronger every year, but we took a low average of $82,000 a year. And we said, hey, let's make everything work. I know you said 10 to 15 years, but let's make everything work on a 10, knowing that if we need to cut out on an 8, this thing would have offset on a -2 at 8 years. But, if we work on it at a 10, you're still working past the 10th year. You still own the business. You can still contribute to it. And so what we did was, we took these 2 numbers and we said, we want to reallocate 33% of the portfolio into par. So even though he was all in fixed income, we're not taking the whole thing. We're taking what makes sense to him because this client still wants to see a good, strong cash position on his balance sheet, and he's taking his risk in his business. And so when you take this out, what this number is, and this over 10 years, it's $1.5 million. If we're redirecting $500,000 of it, right, it's going to give us what that is over 10 years. It's going to tell us what our annual premium is, and it's going to give us an initial face amount. And so this is a Wealth 100, and we're doing it on 10 deposits, and we're comparing against the 3% portfolio that he's matched us up to. Now, I will tell you, I was with a client last week. I was really a fish out of water because I was kind of brought in very last second, didn't know much about the client, didn't know what we were up against. We were talking about the benefits of whole life to an older gentleman. And he was comparing this against his equity returns. And I said, well, what about your fixed income? What are you getting there? And he didn't really know, but we were able to set a benchmark. So he gave me a benchmark where he said, hey, if you could beat this benchmark, then we probably have something to talk about. But if you can't, then there's really nothing for us to talk about. And I agreed with that. I said, yeah, that's cool. I'm good with that. And so, what this produces is, it produces like a whole bunch of numbers in that, but this is the one pager that I really like. And it basically just says, hey, Mr. Client, you just keep doing what you're doing. Like if we never met, you just keep doing what you're doing. You'll have plugged $1.5 million into your portfolio, into that fixed income at 3%. You'll pay a bunch of taxes every year as that's growing. And then when you go to take that out, your family's going to pay some taxes again, right? That's just the way the Canadian system works. So in total, they're going to receive on that $1.5 million that you work so hard to save and earn, they're going to get 2.1 million bucks of it. And you'll have transferred away $2.5 million in the way of taxes on that money. Okay, but they're going to get 2.1, which is still bigger than what you put into it. And that's assuming you don't touch this right to 85. If you spend any of this money, they get less. That's just the way it works, right? Versus if we took a look at redirecting a third of the portfolio towards permanent life insurance. Now, understand, we can build an entire portfolio here if somebody actually has a whole portfolio. So when we're dealing with doctors, when we're dealing with dentists, a lot of times we will see an entire portfolio inside there that we're comparing against. In this particular case, we were just comparing against fixed income. With the gentleman that I was talking about from last week, I'm not comparing against his portfolio. I'm benchmarking myself against what he has in fixed income and what he thinks is an appropriate yield. So here, 1/3 being redirected. So out of the 1.5 million, 500 grand of it's going to go into permanent life insurance. The balance of it, he's going to save. He's going to pay some taxes as it grows. And when he passes away, there's going to be $4 million of total estate here, right? So the balance of the investments and the life insurance amount. Of course, this is on current. I could run this at -1 or -2. You can be as due diligent as you want, right? You can show however you want. All I'm just saying is, in this example, it's 4 million bucks. Almost 1.5 of it is in the investments, and 2.6 of it is in the insurance. And so what does that mean? If he wants to spend the investments in his lifetime, he can still leave 2 million bucks to his heirs. And if he planned out and he said, hey, I'm going to spend all this money down from 65 to 85 or something like that when he retires, that would leave 2 million bucks for my heirs. But if he was still alive and he still had life at the end of his money, he could then leverage upon the policy. He could take a cash dividend from that point forward. He has a lot of options and flexibility. He's not locked out of this in any which way. And so what this does is that 33% redirect gives him an 88% bump on his estate, but it gives him more flexibility, more options, and he's not giving up liquidity, use, and control as that money grows. All this is backed by the math. So none of this is just like fictitious pie charts. And so, everything's backed up here by the math, and it makes for a really easy conversation. I will tell you, the guy from last week benchmarked us at 4, currently a smoker, almost a non-smoker. So what I showed him was, if we do this against 4, you'd have to get a 7% GIC alternative over his lifespan in order to match the insurance as a smoker. But if he just waited, if we bound term insurance today and he just waited, converted, and bought it as non-smoker, and he just did that, it would increase to a 9% yield, right? I think it was 9.25. So you'd have to get a GIC at 9.25, a 24-year GIC at 9.25 in order to match out. And that's what got us in that game, is we were able to say, hey, like, here's your benchmark, or here's what you're currently doing. And if you just make this pivot, here's what this does, or here's your benchmark. And if we can beat that, then we probably have something that we should talk about. And it's just a nice, easy conversation to have with somebody once we understand what they value and what they do with their money. And so that's it from my end of the presentation.